Hey there, everyone! Welcome back to our channel, your go-to source for all things finance. Today, we're diving into a topic that affects almost everyone at some point in their lives: credit cards and how they impact your credit score. Whether you're a seasoned credit card user or just thinking about getting your first one, understanding this relationship is crucial. So, let's get started. Now, you might be wondering, how exactly do credit cards affect my credit score? Well, that's the million-dollar question. Let's break it down. First, let's quickly recap what a credit score is. Your credit score is a three-digit number that lenders use to determine how likely you are to repay borrowed money. It typically ranges from 300 to 850, with higher scores indicating better creditworthiness. But what makes up your credit score? It's primarily based on 5 factors: payment history, credit utilization, length of credit history, new credit, and types of credit in use. Each of these components plays a role in how credit cards impact your score, so let's dive into them one by one. First up is payment history, which accounts for 35% of your score. This is the most significant factor. When you use a credit card, timely payments can boost your score, while late payments can seriously damage it. For example, if you have a credit card bill of $100 and you pay it on time, that's a positive mark on your payment history. But if you miss a payment, you could see your score drop by 100 points or more, depending on your overall credit profile. Next is credit utilization, making up 30% of your score. This refers to the ratio of your current credit card balances to your total credit limits. Ideally, you want to keep your utilization below 30%. For instance, if you have a total credit limit of $10,000 and your current balance is $2,000, your utilization rate is 20%. That's great! However, if you max out your cards, say $9,000 out of $10,000, your utilization skyrockets to 90%, which can harm your credit score. Now let's talk about the length of your credit history, which makes up 15% of your score. The longer you've had credit accounts open, the better. This is why it's often advised not to close old credit card accounts, even if you're not using them regularly. For example, if you've had one credit card for 10 years and another for just 1 year, your average length of credit history is 5.5 years. Keeping the older card open can help support a better score. Moving on to new credit, which accounts for 10% of your score. Every time you apply for a new credit card, it can lead to a hard inquiry on your credit report. While a couple of inquiries won't drastically harm your score, multiple applications within a short time can raise red flags for lenders. So, if you're considering applying for several cards, space them out to minimize the impact on your credit score. The final factor is the types of credit in use, which makes up the remaining 10% of your score. Lenders like to see a mix of different types of credit, such as revolving credit like credit cards and installment loans like car or home loans. Having a variety can show that you can manage different types of credit responsibly. So there you have it! Credit cards can significantly impact your credit score in multiple ways, from payment history to credit utilization and beyond. By using your credit cards responsibly, making on-time payments, keeping your balances low, and maintaining a healthy mix of credit, you can enhance your credit score over time. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more financial tips. And if you have any questions about credit cards or credit scores, drop them in the comments below. Until next time, keep learning and managing your finances wisely. Thanks for watching.